The modern financial system is numerically flush with capital. Trillions of dollars exist on balance sheets globally. Yet when participants actually try to use that wealth, the flow often slams into an invisible wall, freezing up entirely. We look at screens, see instant ledger updates, and assume money is moving smoothly. We equate the speed of a digital interface with actual systemic liquidity. Relying on those volumetric metrics is dangerous. Cash reserves, credit facility sizes, and market depth look reassuring on a dashboard, but a high nominal balance does not guarantee you can deploy that value under stress. As this equation shows, nominal wealth simply does not equal usable liquidity. Trusting aggregate data blinds institutions to the friction operating underneath. It leaves them highly vulnerable to sudden operational paralysis. The textbook definitions of liquidity, funding liquidity, market depth, central bank reserves, fail to describe current operational realities. We are operating under a liquidity lock. This is a systemic condition where you formally own an asset, but that value loses its practical mobility and economic command due to layered institutional friction. What matters now is effective access. That means the practical, lived ability to mobilize and settle value exactly when you need it, at a cost you can absorb, without severe obstruction. There is a massive operational gap between apparent flow, the visible transaction counts and rapid digital updates, and your effective access to real purchasing power. Modern financial stress rarely starts with the sudden disappearance of capital. It triggers when the passage from legal ownership to settled discharge is systemically delayed. This split-screen model illustrates the mechanical gap in the plumbing. Clean digital interfaces artificially compress time and counterparty risk. Up top, we see transaction initiation. You push a button and the digital ledger updates instantly. But true settlement capacity happens down below, as the final, irreversible discharge of the obligation. Before settlement is complete, data must grind through dense layers, clearing cycles, correspondent routing, and compliance reviews. Fixed obligations, like an intraday margin call or global payroll, do not wait for administrative comfort. If a transfer is delayed in that lower pipeline, you default. If a settlement lacks finality or timing predictability, the underlying nominal liquidity becomes functionally useless for long-term institutional survival. To verify if an asset is usable under stress, it must pass this rigorous operational framework, the 6 tests of effective access. Tests 1 and 2 are immediacy and certainty, how quickly funds become usable, and if execution occurs without doubt. Tests 3 and 4 cover cost and legality. Can you absorb the haircuts? And will the transaction survive regulatory scrutiny? Tests 5 and 6 demand transferability and preservation. Capital must cross borders while maintaining purchasing power. Fail any single one of these 6 tests, and a formally liquid asset instantly transforms into a trapped, illiquid position during a market shock. The variables dictating those 6 tests are controlled by a specific set of gatekeepers, commercial banks. Banks have evolved from neutral financial intermediaries into the primary adjudicators of circulation. They determine what moves, when it moves, and if it moves at all. Access to your money is no longer an absolute right attached to legal ownership. It is a conditional privilege granted by institutional comfort. In this gatekeeper chain, basic AML checks act as productive friction, but transactions often hit distortive friction, trapped in endless documentation loops. Inside, the regulatory penalty for underscreening heavily outweighs the commercial benefit. The system defaults to block or delay. This posture forces institutions to overfilter. Lawful economic activity is aggressively choked off simply to protect the bank's own compliance profile. Rules originally designed to protect the integrity of the financial system now act as an unpredictable, systemic tax on capital velocity. This distortive friction heavily impacts cross-border corporate treasury transfers. This map shows a cross-border transfer relying on the corridor effect, passing through correspondent banking nodes. If an upstream bank exercises caution, a midpoint node severs the connection. Funds become trapped in the originating country, entirely independent of credit risk. Multinational groups often report massive, consolidated global balance sheets. Those numbers mask trapped local balances that cannot be redeployed to meet group obligations. Your aggregate balance size is irrelevant if the geographic pipeline is severed. International liquidity depends entirely on corridor quality and upstream institutional willingness. Zooming out, we see isolated pools of nominal wealth. Their connections don't flow continuously, they pulse intermittently, governed strictly by institutional comfort. This illustrates a structural divergence, a persistent gap between legal title to an asset and the operational command to move it. This friction stems from a structural erosion of trust across the financial architecture. In a low-trust environment, gatekeepers optimize for defense. They guarantee that compliance safety will always be prioritized over economic velocity. When trust evaporates, the apparent flow on a screen merely masks deep systemic rigidities that can freeze corporate operations without warning. For treasurers, institutional investors, and risk managers, these hidden rigidities require a severe change in strategy. You have to abandon the practice of optimizing for gross liquidity based on clean, aggregated digital dashboards. Instead, organizations must rigorously stress test for usable liquidity. That means measuring exactly how much capital you can actually command across entities, jurisdictions, and gatekeepers when normal market assumptions and compliance corridors break down. Survival in this highly conditional financial order requires acknowledging one harsh reality. Capital only truly exists if you have the unencumbered power to move it.